Ladies and gentlemen, welcome back. To those that were able to join me on my very first episode on this channel for the 10K to 100K challenge, thank you and welcome back. And if you're new here, consider subscribing down below, as this is barely my second video, yet we have a ton of content to cover. So the motivation behind this video is a lot of people, especially a lot of millennials and Gen Z, are starting to figure it out. They're starting to realize that investing over the long run does pay its dividends. And so you have many different brokerage options. Back in the day, you would have to pay a pretty hefty premium for being able to execute trades. Some brokerages like Charles Schwab still charge a commission on options contracts, but that's another video for a different day. They have a different clearinghouse regulations and stuff like that, whereas compared to Robinhood. Now, Robinhood is zero commission, but they do make money off of what's called the bid and ask spread. Again, we're going to look into that later on. So I guess for this video is just an introduction on how to buy and sell stocks. And we're also going to define what a stock is, as well as the different kinds of stocks. So without further ado, if you guys are ready, finger guns, let's get into it. Okay, part one, I guess, of this video will be just defining the different characteristics of different kinds of stocks, which ones you should avoid, which ones suit your needs, because depending on what stage in life you are in, more stable blue chip stocks, maybe dividend stocks, might be exactly what you need if you're approaching retirement, for example. Whereas if you're a young investor and have plenty of money to just YOLO, a good investment might be to invest in growth stocks, which we're going to get into in just a second. Then for part two, we're going to execute some live trades on Robinhood just to show you guys how you can buy and sell stocks for hopefully a profit. I'm also going to buy a couple shares of a dividend stock. Now, obviously those I'm going to have to wait until the dividend date, which most companies pay their dividends quarterly, just so you guys can see that money coming into the brokerage account. Once again, I do have that expander in my mouth. I'm getting better at speaking, but anyway, what you have to understand is there's two, it's kind of like a hierarchy, right? So there's two different classes of stock, if you will. There's common stock and then there's preferred stock. Common stock is normally 99% of what you guys are currently buying. Preferred stock really was more or less more popular back in the day, not so much right now. Buying shares essentially in a company allows you to have partial ownership. And sometimes those companies, they want to know what investors are thinking of where the company should be headed into the future. This is where one of the biggest differences between the two come. Preferred stock typically does not give shareholders voting rights in investor-only meetings. If you do have common stock, then chances are you probably, maybe for those people who have a Robinhood account, occasionally you may receive an email from Robinhood saying that there's an investor meeting and that they'd like your feedback. That's what that is. You can essentially vote, for certain things in the company. Who knows if they're trying maybe to raise some money, or maybe the company wants to know where those funds should be allocated. Sometimes investors have that right, but that's with common stock only. So then you might be asking, then what's the point of having preferred stock? The thing about preferred stock is that those shareholders who own preferred stock are first in line to get paid for dividends, and if that company happens to go bankrupt. Obviously, we definitely don't want to invest in companies that are soon to be bankrupt, but let's just say an example. Let's just say that company X goes bankrupt, and after the fact, they might have 50 million left over to try and give back to their investors. A lot of the times, most investors just lose all their money. Preferred stock owners would be first on that 50 million. If that dries up and there's still a butt ton of common stock shareholders, oh well, you lose out on that money. Same thing goes for dividends. If dividends are starting to dry up, if that free cash flow from a company set aside to pay for dividends, if it's starting to get really tight, preferred stockholders may be first in line to receive that dividend, and some common stock folks will either get a reduced dividend or no dividend at all. Those events are pretty rare though, and normally I'd say you should probably just stick to common stock. Preferred stock does come with a little premium, and to me, it's just not really worth it. Companies, for example, that do offer preferred stock include Bank of America, Georgia Power, and MetLife, and it's just to name a few. Okay, cool. So now we define common stock and preferred stock. Now, the next tier below that is the differences in how they categorize different stocks. So this is going to be between small cap, medium cap, large cap. And in today's environment, now there's mega cap companies like Apple with trillion-dollar valuations, right? So that's great, but we need to define how these tiers will be labeled, right? So the way that the small caps, medium caps, whatever, they're labeled based off of their market capitalization, right? And you can derive a stock's market cap by the following. The formula is stock price multiplied by the number of shares outstanding. So whenever a company goes public, they typically release a certain amount of shares out to the public. Now, later in the future, if the company has a lot of excess cash, they can do what's called a stock buyback, right? So what that's going to do is that company goes in and buys up their own shares. Therefore, the company is leaving less shares outstanding for retail investors, aka the public. And typically what that does, share buybacks typically increases stock prices because there's less out there, and typically more buyers are more attracted when a company is doing stock buybacks because they tend to go up. Sometimes, however, if a company isn't doing too hot, or maybe they want to raise some money, they will sell additional shares to the market, therefore diluting them. So now if there's more shares out in the market, that typically drives the price of each share down because there's more out there. It's pretty simple with supply and demand, right? There are different definitions, but according to Investopedia, a large company is considered a large cap when a company has more than $10 billion or greater in market capitalization. Nowadays, there are companies that vastly surpass that, such as Microsoft, Tesla, or Apple. Those would now be classified as mega cap companies, and typically those include companies with a market cap greater than $200 billion. Now, that's billion with a B. That's a ton of money. So medium cap companies would be classified if their market cap is between $2 billion and $10 billion. Think of companies like Crocs, Nordstrom. And by the way, there's an ETF that tracks the mid cap, large cap, and small cap companies. The ETF that tracks the big cap companies is $VOO. So whenever you have a dollar sign in front of a few letters or a combination of characters, that's called a ticker. And from now on, I'm going to include just the dollar sign with the symbols to correspond to the ticker. That way you guys can easily search this on your brokerage platform, whether it be Robinhood or Webull or whatever. The medium cap ETF that tracks, a good majority of the medium cap companies is the ticker symbol IJH. And now we go over to the small caps, and those are classified as companies with a market cap of roughly about $300 million to about $2 billion. And examples of companies like this are, for example, ticker symbol IIPR, ticker symbol ROG, and ticker symbol EXPO. And the ETF that does track that is ticker symbol IJR, in case some of you guys want to invest in those ETFs. So now we're going to go over to the different classes or subcategories of stocks, if you will. Like, for example, dividend stocks, there's blue chip companies, there's defensive stocks, cyclical stocks, which we're all going to define. But what you have to understand is a company is going to dictate how it's going to reinvest its profits, if any, into the company. There's mainly two options. They can either reinvest all their profits straight back into the company, therefore growing it much faster, or they can either pay it back in the form of a dividend to their shareholders, right? Now, of course, there has to be a profit in order for those dividends to be sustainable. So let's go over just a few categorizations of different kinds of stocks. So first, and it's some of my favorite, it's dividend stocks. Sometimes they call them income stocks. Now, these stocks pay out typically quarterly. There are a few tickers that pay out monthly, and they'll pay out a certain dividend. Typically, these investments tend to be on the safer side. These companies tend to be tried and true and well established. Growth slows if companies start paying a bigger dividend. So if you can imagine companies like Walmart, they're already a behemoth. Their growth basically at this point has plateaued. Imagine Walmart when it first started. Within those first 10 years, it might have gone from a puny little company to now this powerhouse. Well, thing is, it's already a powerhouse, very well established, so there's little room for it to continue growing at the scale it did before. Therefore, companies like Walmart, big companies like that, they'll pay out a dividend to their shareholders. That way, it still incentivizes investors to invest in that company. Otherwise, if these companies just stayed stagnant, no one would invest in them. Now, each company is going to pay a different dividend. It's entirely dependent on the company, and no company is ever obligated to pay out a dividend. Let me reinstate that. What happened during the coronavirus pandemic back in February 2020, a lot of these companies had to start cutting their dividends because they were unsure about the future. There was a lot of uncertainty, right? If a company deems it fit to cut their dividend by half, they will. Now, that's obviously going to cause a negative reaction in the market, but you always have that possibility. But for the most part, most companies, there's different actually kinds. There's dividend aristocrats, dividend kings, and I forget the other one, but I'm going to definitely put an image over here. These are companies that for X number of years have consistently paid and raised their dividend on a yearly basis. So here's just a few tickers. That way you guys, if you guys are interested in dividend stocks, they will pay you every quarter just for owning the stock. So long as you hold the stock, you will continue to be paid out a dividend on a quarterly or monthly basis. This is a phenomenal way and a very conservative way to grow your account size over the long run. Companies that pay consistent dividends include some like Johnson & Johnson, Coca-Cola, and even Apple. Yes, Apple pays a dividend. So those are dividend/income stocks. They pay you on a quarterly basis just for having and owning the stock. And if it's a good company, they will typically raise the dividend every year. So that way you can help battle inflation. You have more money year over year. So the compounding effect really starts to snowball once you give it a few years. All right. Now the opposite of that would be something called a growth stock. With these kind of companies, they tend to reinvest the majority of their profits right back into the company to accelerate the growth. These companies, as you might expect, they do not pay a dividend for the most part. And that's because if a company's main goal is to expand and grow, they're not going to want to pay their investors a dividend because that's going to eat up a huge chunk of their profits. Instead, they want to keep all those profits and reinvest it right back into the company. Now, this could be very good for investors or very bad. A lot of startup companies can be considered growth stocks once they reach a certain hurdle in market cap. But even then, these stocks tend to be really risky and extremely volatile. You have the potential for huge future profits, but like I said, defensive stocks would also help, so you need to diversify and not put all your eggs in one basket. These growth stocks typically tend to have very high PE ratios, which a PE ratio, I'm saying that very weird because of the expander, PE ratio stands for profits to earnings ratio and is derived by the following formula. It's stock price divided by EPS, or earnings per share, which every publicly traded company is obligated to announce their earnings every single quarter. And in that quarterly announcement, you'll have an earnings per share, which on a short-term basis shows you if that certain stock in that quarter underperformed or outperformed. And once you have a good history of overperformance, that's a good stock to own and save for the long run. Examples of big growth companies include stocks like DraftKings, Square, and Uber. Companies that right now may not be making huge profits, but we anticipate them later on in the future to, rake in billions, millions and millions, maybe even billions. So like, for example, DraftKings, here in my state of Georgia, we can't legally gamble yet, but maybe later in the future we will be able to, in which case DraftKings will bring in tons of money. But it's very uncertain when or if that will even happen. All right, we need to chug along. So now we move on to IPO stocks. IPO stands for initial public offering. This is when a company wants to raise funds and they decide to go public. That way, retail investors like everyday Joes like you and me can invest into said company and maybe have that company grow in value. The thing about IPO stocks is they're a little tricky. You think about companies, huge companies like Amazon, they had to have IPO'd at one point. And if you got in at Amazon's IPO, that's a ton of money. That's a ton of profits. But that's not always the case. A lot of times these companies IPO and there's a lot of hype at the very beginning. So it goes straight up, and then short sellers and people come to their senses and realize that this company, say company Y, isn't even profitable yet. That's when short sellers start coming in. People start selling their stock. Common folks like you or me panic sell. They see the stock continue to go down, and that's typically the life of an IPO. Now, whether that company prevails is anyone's guess. But if you take certain examples recently, like Robinhood IPO'd and Rivian, their stock prices look eerily similar, and I anticipate both of these companies to continue going down for the foreseeable future. If they survive and if they can come back up, that's just the life of an IPO stock. So typically I don't like to get into IPOs immediately. I like to wait about 6 months and let everything fizzle out, and then I'll consider buying into that company if it in fact is a good company. So yeah, like I said, examples are like Robinhood and Rivian. Now we go over to ETFs, which are exchange traded funds. So ETFs are just the holy grail of investing. It's a very boring-ish way to invest. There's a lot of jokes on Wall Street Bets that if you invest in ETFs, you're probably a boomer. There might be some, truth there, but yeah, an ETF basically is a collection of a ton of different stocks, little proportions of different stocks combined into one singular stock. That way, you're kind of investing in the broader market, if you will. Take, for example, SPY, ticker symbol SPY. That's the S&P 500, and it tracks the 500 biggest companies in the United States. So in a sense, if you want to invest in the broader market, in the stock market, this is a fantastic way to do it, into SPY. Certain examples of big ETFs include tickers like SPY, IWM, ARK-K, the triple Qs, and then there's also, if you're more advanced, there's triple leveraged ETFs. I would say if you're starting out, don't dip your toes into triple leveraged ETFs just yet. There is a lot of risk associated with them, and typically they do come with monthly or annual charges to just hold those ETFs. So if the stock market, let's say you have a triple bull ETF and the stock market does nothing for 2 years, well, those fees are going to start eating at your shares, and it's just going to be worthless if the stock market plunges, or you're going to get really scared if there's a huge dip in the market. We're almost done. We have blue chip stock companies. These are large, stable companies that have predictable growth and earnings per share. They have a long history of stable earnings, and most blue chips pay a dividend, which is a nice bonus. They typically are at risk for reduced growth, though, since companies are already well established. Again, we've already mentioned that. Typically, you want to see returns in the form of a consistent dividend with these kind of blue chip stocks. These are great companies to dollar cost average during a big dip or during even a bear market. And examples include companies like IBM, Microsoft, and General Electric. I do want to have at least 10 minutes to actually secure some of these stock plays. Okay, so now we move over onto the danger zone, and these stocks I would 100% not recommend. These are considered hype stocks. Some people call them meme stocks, also penny stocks, speculative stocks. These are FDs. Basically, if you want to lose your money, go ahead and invest into these kind of companies. These are literally just a gamble. You might have better luck just going, showing up to the casino. Literally, this is a gamble. So hype stocks are typically companies that are in deep trouble. They've been in the red for several years. They may have a ton of debt, and they're just, anxious to get out of it some way or another. So a lot of people, now don't get me wrong, there's insane amount of growth. Now, obviously the superhero story is Tesla. So in its infancy, Tesla had a lot of haters, a lot of non-believers, and it was on the brink of bankruptcy. However, it did prevail, and now look at the behemoth that Tesla is. That would be an example of a successful speculative stock play, because EVs, 10 years ago or whatever, investors weren't sure. There just was a lot of uncertainty with EVs, but now that they're becoming more mainstream, obviously Tesla's on the way up. So just as much as there is potential for massive gains, you can very quickly lose all of your money just like that, especially if you dive straight into options on penny stocks. My goodness, that is a horrible decision. You will lose all of your money, or most of your money, I promise you. I have never invested into any penny stock. Actually, I did once, and it was on CEI, and it was a very quick bearish play that was in the 5 figures. So yeah, companies like this would be, like a company like CEI comes to mind. All right, last type of stock is cyclical stocks. These are stocks that cycle with the economic cycles. It's sort of self-explanatory. A perfect example would be like at the beginning of the COVID pandemic. Cruise stocks and airline stocks were getting battered, among others. Okay, so here we have it. For those of you that have watched my first episode on the 100K challenge, at least this will be a small little update. We're a little up on the day, but most importantly, as you can see right here, we have buying power. So I do have a margin account, but for this challenge, we're trying not to use margin. Margin typically gives you 2 times buying power on whatever cash you have. So for example, if you deposit $5,000 in cash, if you have a margin account, Robinhood will offer you an additional $5,000 to invest. Now, obviously that doesn't come free. You're going to have to pay an interest rate on that. And there's a lot of risks. If you're over leveraged and the stock market goes the opposite way of what you want, you are at risk of being liquidated, and you never want that. That's when Robinhood goes in and sells all your securities for you just because, everything went tits up. So anyway, we're going to buy different examples of stocks. Now, if we have 1559 divided by 2, we have a little over $750. So we're not going to try to go over 750. So let's go ahead and start with an ETF. I think that would be great. Let's go ahead and buy the small cap ETF, which again is, I believe, IJR. There we go. So right now, let's look at the chart. It's kind of trading sideways, as you can see here. Now, these charts on Robinhood are atrocious. Again, I would prefer a much advanced platform like Thinkorswim. But anyway, we're going to buy just one share at $113. So we have about 650 left over. So all you do here is you're going to hit market price. Make sure it's in shares. You can invest by a dollar amount. So if you didn't have $113, you can instead invest $50 and receive, or let's say $55, just to make it a better example. You'll receive an estimated about half a share. But in this case, we're going to do a full share. We're going to do one share. You go to review order, and now check what it says here. It says you're placing an order by one share of IJR that will be converted to a limit order with a 5% collar. Just know that's a lot of legal mumbo jumbo for we'll try to get you the best price possible. So we're going to hit buy, and it was placed and it immediately filled. So we spent $113 on this ETF. Now, this will be accounted for in the road to a 100K challenge. So on week 2, I'm going to jot all of these trades down and show the receipts in episode 2. No worries. So we bought an ETF. Now, of course, the goal is we want this stock to rise, or we want this ETF to rise in value. That way we can sell it later for a profit. And hopefully whenever I do so, I can show you guys. Next up, let's get a different example. Let's do a growth stock. So that's a very volatile and risky company that could potentially bring in a ton of cash in the future, but at the same time, it could drop like a tank. A perfect example would be DraftKings. Look at this. In March 19th of just the previous year, DraftKings was on a rally. It almost hit $75. Since then, it's been on a tumble, and it's just been going down. Remember, guys, the trend is your friend, and we can easily identify a downward trend. But I think that after some time, here, let's go to the 5-year again. I don't trust Robinhood's graphs, but as you can see, I think we're starting to bottom out. It may start to curve this way. So we're just going to buy one share in DraftKings at $26. So not too bad. So it was placed and it should get filled. There we go. So now if we go back to our portfolio and if we go to the stocks that we're holding, here we go. So we have 4 shares of IWM that I purchased on episode 1 of the Road to 100K. And now we have IJR, and DraftKings it's saying it's still pending. There we go. And lastly, let's go over a large cap company. So a tried and true would be something like Apple. Actually, this isn't the last one. We still have to buy a dividend stock. Now, Apple does pay a dividend though, but the dividend yield is so low that not many people would consider this a traditional dividend stock. It has a yield of only 0.5%, so it's not that much. I don't know right now what it's paying, but you can easily Google Apple dividend history and it'll give you a list of the most recent prices. Apple right now is kind of trading sideways right now. So as you can see, since about December 8th, it's just traded right here along this trend. And so what we're going to do is we're going to buy one and hope for a breakout really soon to the upside. Now that could happen, but equally it could also drop. But we're going to take our chances. We're going to buy that. Now we should have enough money for just one last share, and it's one of my favorites. It's Coca-Cola. It's a company that a lot of people overlook, and yet there's Coca-Cola products all around us. I guarantee you, if you're a soda drinker or not even a soda drinker, Coca-Cola has products in juice and water and energy drinks. It's insane how big Coca-Cola is, and they pay a very consistent dividend, and they have a yield of about 2.78%. So it's pretty nice compared to what we're paying. And as you can see, look at their 5-year. You can see, remember, the trend is your friend. It's been on an uptrend for the past 5-10 years as Coca-Cola continues to expand worldwide. We're going to buy one share, and Coca-Cola is a long-term hold. We're going to hold this sucker for a really long time and hopefully expect consistent dividend increases over the years. So over time, we're going to continue to add Coca-Cola stock to our portfolio. All right, guys. Yeah, that's everything I wanted to show you guys. That was simply how to buy shares on Robinhood. Once we get to selling, I'm going to make a separate episode on how to sell and tips and tricks on when to sell. So the good thing is most platforms, most online platforms do a pretty great job of tracking your performance. Most brokerages will show you if you're, making a profit or currently, down a bit. So we're just going to have to wait and see. Remember, here at the Diamond Hand Prodigy, we live by our name. We have those diamond hands and we continue to hold. There are instances where you should always have an exit plan. Always. Tried and true companies like Apple and Coca-Cola, I'm pretty sure that over the long run, we're just going to hold, pick up some dividends, and also have the stocks appreciate so we can collect some capital gains. All right, guys, I know that I try to get this video under 20 minutes. It's really hard to squeeze all of this in, but I hope that this video was packed full of information. That's Robinhood 101 on how to buy stocks and also a little background on the different kinds of stocks. I hope this video was useful. Sometime next week, I'm going to go ahead and do week 2 of the Road to 100K challenge. Hopefully, I'm expecting at least a 10% increase on the week. We're just going to have to see what the stock market does. But until then, guys, stay safe, take care of each other, and I'll be seeing you guys real soon.